Picture a market screen that's bleeding red. The headlines are screaming. A war, a surprise inflation print, a CEO scandal, a downgrade, and everyone thinks they know the cause. But the tape tells a different story. Most markets don't collapse because the news is bad. They collapse because something far more ordinary disappears. The buyer. Not the optimistic retail buyer. Not the buy the dip meme buyer. The real buyer. The one with size. The one who makes prices real. And the uncomfortable truth is this. In the moments that matter most, that buyer isn't a person. It's a promise, a rule, a balance sheet, a model, a machine that only works when the room is calm. So the question isn't, what bad news hit today? The question is, what disappeared right before the crash? Because if you understand that, you stop being surprised by crashes. You start seeing them load days or weeks before the headline. Let's tell the story the way markets actually live it. There's a party, there's a door, there's a crowd, and there's one person at the entrance whose job is to keep things orderly. That person is the buyer of last resort in normal times. The market maker. And when market makers step back, the floor doesn't fall because someone pushed it. It falls because no one is holding it. Now, before we go further, a quick reset. When you see a price for a stock, a bond, a crypto coin, an index, it feels like a fact. Like gravity, like the temperature. But a price is just the last trade between a buyer and a seller. If buyers are abundant, sellers can sell without panic. If buyers are scarce, sellers compete to get out first. So crashes aren't really about prices. They're about liquidity. And liquidity is not money. It's not cash in the system. It's not a central bank headline. Liquidity is the ability to trade without moving the price too much. In calm markets, liquidity feels infinite. You click sell, it fills. You click buy, it fills. Spreads are tight. Volumes look healthy. Everyone thinks the market is deep. Then, one day, a small wave hits. And you realize the ocean was shallow. Here's the simplest way to understand it. Imagine a crowded theater. The movie is boring, but nobody cares. People are relaxed. Then someone yells, fire. Does the stampede happen because the fire is huge? No. It happens because the exits are narrow and everyone tries to leave at once. Markets are the same. Bad news is the shout. Crashes happen when the exit is narrow. And the exit is narrow when buyers vanish. So what makes buyers vanish? Not fear, exactly. Fear is everywhere in markets. Fear is normal. What matters is whether someone is paid to stand in front of fear. In modern markets, the someone is often a market maker, a dealer, a liquidity provider. Their job is not to predict the future. Their job is to quote prices. To stand ready, I'll buy here, I'll sell there. They make the exit wider. But they are not charities. They don't provide liquidity because they love you. They provide liquidity because it's profitable, until it becomes dangerous. And the moment it becomes dangerous, they step back. That's the buyer that disappears. Now, to really feel why this matters, you have to stop thinking of markets as crowds of humans. Think of markets as a chain of balance sheets. Every buy is someone holding risk. Every sell is someone offloading risk. In between, someone intermediates risk for a fee, until their risk limit says no. Crashes happen when the intermediaries hit limits at the same time. So let's build a crash from scratch, slowly, and watch where the buyer disappears. Start with a normal day. A fund wants to sell a chunk of something, say corporate bonds. In a normal market, they don't need a perfect buyer. A dealer will take the bonds onto their balance sheet, hold them briefly, then distribute them. The dealer earns the spread. That's liquidity. Now add stress. Rates rise. Volatility rises. Suddenly, holding inventory is risky. The dealer's risk manager doesn't care about the headline. They care about one thing. How much could we lose before tomorrow morning? So the dealer widens their spread. They quote lower bids. They reduce size. They say, I'll buy but not much, and not at yesterday's price. Liquidity is already thinning, but it doesn't look like a crash yet. Now add one more ingredient. Everyone's model starts saying the same thing. Value at risk, margin requirements, volatility targeting, risk parity. Different names, same behavior. When volatility rises, these systems reduce exposure. So now you don't just have some sellers. You have systematic sellers, forced sellers. And forced sellers don't negotiate. They dump. At this point, it still doesn't crash if someone is willing to catch it. If the dealer catches it. If the market maker catches it. But here's where the buyer vanishes. In stress, the dealer's balance sheet becomes the scarce resource. Balance sheet is like oxygen. You don't notice it until it's gone. Dealers are regulated. They have capital requirements. They have internal limits. They can't just absorb infinite selling. And they can't reliably hedge if correlations spike and everything moves together. So they step back. They don't say it on TV. They don't tweet it. They just stop quoting aggressively. The bid becomes a rumor. And then you see it. Price gaps. Flash moves. Disorderly markets. Not because news got worse. Because the market lost its shock absorber. This is the moment people misread. They look at a chart and say, everyone panicked. But the deeper truth is more mechanical. The market ran out of intermediaries willing or allowed to intermediate. And that's what disappeared. Now let's bring in the hype versus reality part. Because this is where a lot of smart people get fooled. The hype is, there's so much liquidity in the system. Central banks printed money. There's trillions on the sidelines. Retail is buying the dip. The reality is, liquidity is not sitting there like a pool of water waiting to be scooped. Liquidity is a service. And like any service, it can be withdrawn. You can have enormous amounts of cash in the world and still have a liquidity crisis. Because cash doesn't automatically become bids at the exact moment you need them. In a sell-off, buyers need three things. They need conviction, they need time, and they need permission. Conviction. They believe prices are cheap relative to risk. Time. They can wait out volatility without getting fired or margin called. Permission. They are allowed by their mandate and risk rules to buy. In a crash, those three disappear together. Conviction collapses because nobody knows the bottom. Time collapses because leverage demands immediate action. Permission collapses because risk systems lock down. So the buyer vanishes. That's why the market can fall even if everyone knows the asset is undervalued. Knowing doesn't matter when you're forced. Now let's make this tangible with a scene that keeps repeating in modern markets. It's 9:31 a.m. New York time. Something hits. Maybe a data surprise, maybe a policy headline. Futures drop a little. Algorithms respond. Volatility ticks up. A volatility targeting fund sells a bit. A risk parity fund sells a bit. An options dealer adjusts hedges and sells a bit. And then, quietly, the market maker pulls back. Spreads widen. Depth disappears. It becomes harder to execute without moving the price. That itself is information. Other algorithms detect it. Now they sell faster because they know liquidity is evaporating. And in that feedback loop, the market moves in a way that looks emotional, but it's actually structural. Here's the brutal part. Liquidity is procyclical. It's abundant when you don't need it. It's scarce when you do. That's why crashes feel like suddenly. They are not sudden. They are a gradual drying of liquidity, followed by one moment when the remaining thin layer snaps. So what are the specific things that make buyers vanish? There are a few repeat offenders, and they're not exotic. First, leverage. Leverage doesn't just amplify returns. It amplifies urgency. If you're leveraged, you don't sell because you changed your mind. You sell because someone else changes your options. Margin calls, collateral requirements, haircuts, the mechanics of show me more cash now. When leverage is high in a system, a small price move can trigger forced selling. Forced selling doesn't wait for fair value. It chases liquidity. So the moment leverage unwinds, it eats the buyers. Second, volatility itself. When volatility rises, it changes the cost of holding risk. Options get more expensive. Hedging gets harder. Risk systems tighten. Position sizes shrink. It's like your car's brakes suddenly become weaker while you're going downhill. That's when market makers demand more compensation, wider spreads, or they step away. So volatility doesn't just reflect stress. It creates stress. Third, correlation. In calm times, diversification feels like protection. In stress, correlations go to 1. Everything moves together. That's not philosophical. It's forced. When people sell to raise cash, they sell what they can, not what they should. They sell liquid things. They sell winners. They sell indices. So even safe assets can fall temporarily, not because they're risky, but because they're tradable. In those moments, the buyer isn't missing in one market. The buyer is missing everywhere. Fourth, dealer balance sheet constraints. This is the one most people never look at because it's not dramatic. But it's the difference between a sell-off and a crash. Dealers do not have infinite capacity. When they hit limits, they reduce activity right when the market needs them most. This is why the same kind of news can produce completely different outcomes in different environments. Sometimes bad news hits and the market shrugs because balance sheets are open. Sometimes mild news hits and the market collapses because balance sheets are closed. And if you want a shortcut way to read this, a crash is often a balance sheet event wearing a news headline as a mask. Now, if you're thinking, okay, but aren't there always buyers? Yes, there are always people who would like to buy at the right price. But willing buyers and effective buyers are not the same thing. A pension fund might want to buy, but moves slowly. A long-only manager might want to buy, but is already fully invested. A retail investor might want to buy, but is too small. The market needs someone who can buy now, in size, without needing permission from a committee. That's what disappears. And when it disappears, prices don't glide down. They jump. Because the market doesn't fall one seller at a time. It falls when the order book is empty enough that one big sell order turns into a vacuum. This is why you see those airy moments. A chart that looks like it fell down a staircase. Not a smooth decline. A series of air pockets. Those air pockets are missing buyers. Now let's zoom out. Because this isn't just about one scary day. It's about the way modern financial systems are built. For decades, markets have become faster, more automated, more interconnected. And that has benefits, tighter spreads, cheaper trading, more access. But it also means more of the buyer function has moved from humans to systems. Systems are efficient. Systems are also brittle. Humans can look at panic and say, this is irrational, I'll step in. Systems look at volatility and say, risk is higher, reduce exposure. So in the moments when you need irrational bravery, the system delivers rational retreat. And that's the second uncomfortable truth. The buyer that disappears is often not sentiment. It's the structure of market liquidity itself, mechanized, rule-based, and synchronized. That's why the same pattern appears across assets that seem totally different. Stocks, bonds, crypto, emerging markets, even certain commodities. Different stories, same ending. Buyers vanish. Price discovers the next level down. So what should you watch if you want to see it coming? Not the headlines. Watch the plumbing. Watch spreads. Watch market depth. Watch funding stress. Watch volatility in options. Watch whether safe assets are acting strange. Watch whether there are sudden gaps and failed bounces. When markets try to bounce and can't, it's often because buyers aren't there to support the rebound. You get these dead cat bounces that feel like relief until they fade because liquidity never returned. Another tell is when price moves become discontinuous. When you see small news cause huge moves, that's usually a liquidity signal, not an information signal. Information changes slowly. Liquidity can vanish in minutes. Now, let's confront the big implication. Because this is where the story becomes about more than markets. Liquidity is a form of trust. It's trust that you can exit when you need to. It's trust that the market will behave in a continuous way. It's trust that the system will catch you if you trip. When liquidity disappears, trust disappears. And when trust disappears, the economy feels it. Because markets aren't just charts. They're financing conditions. If bonds can't be sold without huge discounts, companies pay more to borrow. If stocks gap down violently, CEOs freeze spending and hiring. If banks see collateral values swing, they tighten credit. Suddenly, what started as market volatility becomes economic slowdown. This is the transmission mechanism most people miss. Crashes aren't just wealth losses. They are a tightening of the system's ability to fund itself. And that's why central banks, governments, and regulators react so quickly during real liquidity crises. Not because they care about your portfolio, because they care about the pipes. They know that in a true liquidity event, the market is not finding a fair price. It's choking. But here's the tension. Backstops help. They also change behavior. If participants believe there will always be a rescue, they take more risk, more leverage, more duration, more fragile structures. So the system becomes more reliant on liquidity providers, who are themselves more constrained, and the cycle tightens. This is how you get a world where markets feel stable for long stretches, then snap violently. It's not that risk disappeared. It's that risk was being warehoused quietly. Then, one day, no one wants to warehouse it anymore. And that's the final piece of the puzzle. A crash is not a judgment about the future. It's a moment when nobody wants to be the bridge between today and tomorrow. The buyer disappears because being the buyer becomes a career risk. Buying in a crash requires you to be wrong before you are right. It requires you to endure mark-to-market pain. It requires you to survive meetings, redemptions, and margin calls. Even if you're correct in the long run, you can still lose in the short run. So the smartest institutions often step back at the exact moment the opportunity is greatest. Not because they don't see it, because they can't carry it. Which brings us back to the thesis. Markets don't crash on bad news. They crash when buyers vanish. So what disappeared? Not optimism, not confidence. What disappeared was the ability and the permission to hold risk in the middle of chaos. Balance sheet capacity, liquidity provision, risk budget, time. And if you want a single sentence to carry forward, it's this. In a crash, the price is not falling because everyone learned something new. It's falling because the system temporarily forgot how to make a market. Now here's the question I want to end on. If the real danger is the disappearance of the buyer, and if more of the buyer function is now automated, rule-based, and tightly constrained, then in the next true crisis, who do you think is actually supposed to step in? And what happens if, this time, they hesitate?